Good afternoon, or good evening, I should say. And thank you very much for having me on the show. I am going to launch straight into a bit of an introduction of what we do at AVI, at the Japan Opportunity Trust. I will hopefully be able to share my screen shortly. Just as by way of introduction, AVI, for those who are not familiar with us, Asset Value Investors has been around for 40 years. It was set up to run the assets of what was called the British Empire Trust, which some people might be familiar with. And we launched our own dedicated Japan strategy back in 2018. Hopefully everybody can see that. So the first thing to say, I suppose, is that yes, we've been going since 2018. Actually, the strategy was launched within the Global Trust 2 years even before that. So really, it's been since 2016. And over the years, it has grown quite significantly. Last year in November, for those who've been watching the space, you will have seen that we merged with the Fidelity Japan Trust, and our assets now are over £400 million within the trust itself. I just wanted to take a step back to begin with and talk about Japan. Japan has obviously been really motoring for the past few years, and we do sometimes get asked, you know, has the ship sailed? Have people missed the opportunity in Japan? And we would suggest that absolutely not. It just depends where in Japan you are looking. So this strategy was started, as I said, 8 years ago. And the reason it started was because of the recognition that something really exciting and really special was happening in Japan. And that was, of course, the advent of the Corporate Governance Code, which was first implemented by Prime Minister Abe about 10 years ago now. And because we were investing in Japan through the Global Fund, we were able to recognize very early that this change was really happening on the ground with the companies that we were talking to. And yes, of course, like many other investors, we thought, oh, we've heard this all before. Japan has done this before. Is it really different this time? We felt very much yes, and so much so that we did launch this standalone strategy. What is interesting is that even though these changes have been happening for the past 10 years, it's only really been in the past 2 years that we've seen an additional investment come into Japan from global active investors. That said, most people are still underweight Japan. If you look at data from eVestment, over 50% of active global managers are still underweight Japan, and 17% of those have no exposure at all. And, you know, obviously, the Japanese market has been doing really well, but it has been quite a narrow subset of that, which has been pushing the market higher. The reason we built the strategy as we did all those years ago is because we saw a real opportunity, particularly in the small cap space of the Japanese market. And why is that? I mean, it's not particularly complicated. The small cap area is significantly undercovered. About 90% of the companies that fall within our universe have no analyst coverage at all, no sell-side analyst coverage, or maybe just one analyst covering them. So there's a real part of the market that is undercovered and really undiscovered. And we feel that there's a huge opportunity there for people who are willing to do the work. It is also still significantly undervalued. And very rich in assets. You can tell by our name, Asset Value Investors. We kind of do what it says on the tin. We really focus on parts of the market that we feel are trading at a discount, that have non-core assets on the balance sheet, whether that be cash, investment securities, or real estate, and that are not very well covered, and therein lies the opportunity. So Japan has been full of those companies for a long time, as I said, particularly in the small cap area, but it's really been this wave of corporate governance reform that is allowing some of those companies to really realize their true value. And we feel that the way to really push that forward is through activism. So the strategy, to summarize, is small cap focused for undervalued stocks, which are asset rich, and which we can make a difference with through activism. So we have been an activist strategy from the get-go, and that is really central to what we do. And that, of course, was done on purpose to try and capitalize on this corporate governance reform in the best way we could see. And in terms of the market around us, you can see here, yes, there's still a lot of opportunity there. The regulatory tailwinds continue to blow in Japan. There are some significant changes coming through this year as well. And we're seeing it in the numbers. You know, the proof is in the pudding. We've got multi-year highs in buybacks, in shareholder return. Activists are getting more involved. We have a number of new activist funds coming out in Japan, which is great. And the number of shareholder proposals is also increasing, showing that that shareholders are now becoming more engaged with the companies that they're owning. Cross shareholdings, which have been a real hurdle for some investors in Japan, that number has halved now in the past 10 years. So there's real progress. And the really interesting thing that has been relatively new in the market is the presence of private equity. So this is very much a part of day-to-day living now in the Japanese market. Private equity are quite vocal about saying that they think Japan is the most exciting market globally, and it has been for the past couple of years. They like the sort of companies we do, which are, as I said, cheap, cash rich, and importantly, companies that have been undermanaged for a very long time and who we can help realize increased value through improving the operational efficiency of those companies. So 8 years ago, when this strategy started, it was just English bloke sitting in London. It was Joe, our CEO and CIO, but he was very clear about a few things. As I said, the opportunity set we feel is the most compelling within small caps. A lot of small cap companies have never had a foreign investor on their shareholder register before, let alone a foreign activist. He didn't want there to be any language or cultural hurdles, so building a bilingual, bicultural team was really important. The other thing that is really key here is the background of a lot of our analysts. We focus very much on drawing from management consultancy expertise. And the reason for that, again, is that activism piece that we really focus on. So in terms of what the portfolio looks like, we are lucky in that there's still a very wide opportunity set out there. So our portfolio is very diversified, but you can see here that we focus very much on the smaller end of the market. So really, most of what we own is sub £1 billion in terms of market cap. And on the left here, you can just see highlighted the point that I made about looking for undervalued small to mid cap companies, which are asset rich. They have to have a certain level of quality. And what we mean by that is there is no point buying a company if it is going to degenerate, if the quality of that business, the actual underlying business, is going to degenerate over time. There has to be a level of quality of that company in terms of the business being decent, preferably growing even a little bit, preferably generating some cash. And critically for us, there has to be engagement prospects. So we have to have a really compelling agenda where we feel that we can actually make a difference to the valuations of these companies. And of course, from a practical perspective, liquidity is key. So we take this really large market of 4,000 listed companies, and we distill it down through our investment process into a very concentrated portfolio of around 20 companies. I would say of those 20 companies, about 15 of them are what we would call core holdings, where we are actively and very intensively engaging with the company. And then the other names are ones that we are sort of building up or coming out of. And we start off with a screening, and we screen for those qualities that I already mentioned in terms of valuation, what we call net financial value, which is the value of the non-core assets. We look at the shareholder register, which for an activist fund is incredibly important. And that is another way in which we try to avoid falling into value traps, because there is no point investing in a company if you cannot influence change within that company through ownership. And so really understanding who owns the company, what their relationship is with each other. And sometimes in these small cap companies, it can be things like they went to university together, or they're social friends through the golf club or whatever it is. But you really have to understand who are the people on the shareholder register, and will they ever vote against the management? And that is another way, as I said, we try to avoid the archetypal value trap in Japan. So we do our initial screening, and then we do what we call desktop research, which is, I think, sort of what most people do, which is, talk to the company, look at the company financials, maybe speak to a sell-side analyst, etc. And only then, when we feel that there is a strong investment case married with a really compelling engagement argument, will we then go into what we call phase 2 of our research, which is in-depth. And this is where I think the team really sets itself apart, and where the management consultancy expertise also really comes through. So we don't just speak to the management teams when we think about investing in a company. We are also looking at speaking with board members, with ex-employees, where where they give a very honest opinion about the culture of the company, for example. We will also speak to industry experts, as well as, of course, doing our own research through interviewing the company. And we need to understand a few things. We need to understand how decisions are made, who makes them, what are the hurdles internally that they see for the company, what are the opportunities, how open are they to engagement with us if we were to invest. And only if all of those things line up do we then take a position. What is interesting about that process is it can take some time, and what you get at the end of it is a presentation that can be 70, 80, 100 pages long, that is essentially like a management consultancy style, McKinsey style presentation, which we then will present to the company when we start engaging. And what that does is it positions us in a slightly different way, we feel, to the majority of activists or engagement strategies in Japan, because the vast majority of them will focus just on the balance sheet. And what we recognize pretty early is that if you are the CEO of a small cap Japanese company and you have lots of cash on your balance sheet, and your valuations are trading below 1x price to book, which many of you will know is the sort of the key level with which the Tokyo Stock Exchange will be focusing on companies, trying to urge them to raise their valuations. If you are a company in that position, you are probably incredibly bored of having foreign shareholders come in and foreign investors come in and tell you, you're doing this all wrong, you've got all this cash on the balance sheet, and you need to give it back to us, the shareholders. That is not what keeps these CEOs up at night. What keeps them up at night is much more on the operational side of things. They know that they are under pressure to improve their valuations. They know they have to get their margins up. They know they have to streamline their balance sheet, yes, but they're not exactly sure what to do with it. There are so many things that they focus on, which is actually in their minds are more important than shareholder return. And that is the solution. That is the problem for which we try and bring a solution. So when we bring them all of this work that we've done over these 100 pages, and we say, look, we've done all this work on your company, and we think your company is amazing at doing X, Y, Z, but it's not so great at doing this. We understand that you're feeling pressure to shut down this part of your business, but also that you don't want to fire 50 people. So we've actually come up with a 3-year roadmap, let's say, of how you can get your valuations from X to Y, how you can get your margins from X to Y. And we've actually laid it all out for you because we're using our management consultancy backgrounds to do the work on your behalf. And this entirely reframes the discussion and the starting point, because you're coming to them with a solution rather than trying to sort of bully them into doing a giant buyback or increasing their dividends. And we like to do most of this. Well, we would like to do all of it actually behind closed doors if we could. We would like to do all of it privately if we could. We really believe that we sit somewhere in between the range of the incredibly constructive, super friendly, more Japanese style of engagement, and the more American style of activism, which can be a little bit more antagonistic. And we really trying to stay as constructive as possible throughout the process. Now, that doesn't always bear fruit as quickly as we would like. So we are able to, and have done, and are currently taking things public with a small number of companies. So since the beginning of the life of the strategy, we've only done it 8 times. However, there are situations where we feel that we have to exert more pressure, and this is where the activism piece comes in. So shareholder proposals, we've done minority tender offers, we will replace board members, etc., etc. So we can go down that road if we want to, and we currently actually have two campaigns which are public within our companies. In terms of what the portfolio looks like, we sort of believe in, go big or go home in terms of our portfolio positioning. No one is paying us to be passive, Joe likes to say. We take big positions, and part of the reason for that, of course, is because of the activism focus. So we like to be, if not the largest shareholder on the register, maybe one of the top three. And the reason for that, of course, is because it gives us a seat at the table. It gives us a louder voice when it comes to discussing things with management. And there are some companies, as you can see here, under the AVI percentage ownership column, where we will own over 30% of the company. And the question I usually get around this is, well, how on earth do you get out of these positions when you own 20 or 30%? And you're investing in small, supposedly relatively liquid stocks? How do you get out? And the answer is that it's actually easier, we have found over time, to get out of companies where you own 20 or 30% than if you own 12 or 13. And the reason for that, again, is because the relationship is on a totally different level when you own that much of a company. And you are able to influence them much more. And we've been relatively successful at exiting large positions like this through encouraging companies to do a large buyback when we feel like our engagement agenda has been fulfilled, and we can exit that way. So it's not as scary as it looks at first glance. In terms of what kinds of companies we invest in, you can see there's a whole range of different industries here. There are 2 in logistics. We think that's a really interesting sector overall for the kinds of companies that we like. And you can also see, we have a pretty concentrated portfolio. As I said, our top 10 positions make up about 70% of the NAV of the trust. So I think, I hope I have time just briefly to go through an example to try and bring this to life, because I know it's a lot of talking, and it's quite different what we do. So just to briefly take you through one, this is a company called TSI Holdings. It is a retail company, and when we first found it, it was very typical of the kind of company we like. Nobody covered it. It was actually it was a micro cap technically back then. And they had about 100 different brands under their retail umbrella. And we felt like they had a lot of assets sitting on the balance sheet that weren't being properly valued. But the most exciting thing for us was that they were sort of shockingly undermanaged. They had operating profit margins of about 1% versus their peer group, who were more like 6%. At the same time, when we were doing our initial assessment, we felt that their real estate portfolio, as I mentioned, was a lot more valuable than the market had given it credit for. And we were so interested in this, we also got a third-party independent valuer to come and assess the real estate. And they said to us, well, actually, we think it's even worth more than you think it's worth. So that was very interesting. So it was this really wonderful combination of a company that needed to have operational improvement as well as that capital allocation story. And so we invested in the company, we started working with them, we came to them with the big presentation, we said, this is the plan that we think you should implement. And they said, you know what, we get it, we agree, but it's so overwhelming for us. We're a small company. We just don't have the resources to make all these changes that you're suggesting. And what we were suggesting was not rocket science. We said, move more things online, take out some of these brands that don't actually make you any money, and streamline your operations and your logistics and your warehousing, because you're treating all of these brands like they're individual companies. And so what they ended up doing is actually bring in a management consultant to implement the ideas that we had come up with. And they came up with a new medium-term plan, which we helped them out on. And as soon as that became public and people saw that they were now forecasting margins of 6% rather than 1%, you could see that the share price really started to move. But the big win for us was, of course, that was very exciting. But the real estate portfolio, and in January of last year, they sold one building, and that one building was in the equivalent of, let's say, Mayfair in London, and it was worth 30% of the market cap of the company. And it's such a great example, I think, of the kind of hidden value that is still there in these small cap companies, and just because no one has really sort of done the work to try and get an accurate valuation on the real estate assets. And after they did that, they then started talking about buying a competitor at some like ridiculously inflated price. And we thought, you know what, we've been invested now for 3 years. The share price has gone up 4 times. You've done most of what we've suggested. It's been a great relationship, but it's probably time for us to go and find an alternative place to put this money. And so, as I mentioned earlier, this was one of those examples where we pushed for the company to do a buyback, especially now that they had all this cash, and we sold out of the entire position. I think at the time we owned about 20% of the company. We sold out of the entire position into that buyback. So it was quite a neat exit for us. And I think my timer is almost done. So I'm going to come off screen and see if you wanted to do some Q&A, Ian.
Nicola, thank you so much. Thank you so much. That was fascinating, actually, that run through TSI Holdings. We have got some questions, but in the World Cup spirit, if everybody wants to have a hydration break, please go ahead. Actually, a couple of questions, Nicola. I kind of, because the topics is at an all-time high. So Martin Beckenham has asked, are valuations an issue? Have corporate earnings risen by a similar amount to the index? Interesting one.
Yeah, so I think there's been a bit of a normalization. So what's interesting about Japan is that much of the earnings growth, so the EPS growth in Japan over the past, 8-9 years has actually been on a par with the US. It has never been reflected in the market. And also, we are still seeing, so 2026 and 2027, the forecasts across the street are for continued EPS growth. And what we're seeing is actually, for a lot of these companies, the overall cash pile isn't actually going down, even though shareholder return is going up, because they're still making so much cash, it's continuing to pile up on the balance sheets. Okay. And equally, there's been quite a skew in terms of where a lot of that earnings growth has been seen. So it's a bit of a generalization, but if you look at what's happened over the past 3 years, most of the strength in the index has been driven by exporters, of course, because the yen crashed 3 years ago and has stayed at a really low level since then. So that's very beneficial for the big auto companies and the trading companies and the steel companies, etc. And then, of course, more recently, you've had, like you've had everywhere else, the big AI boom. And that has really been what's been driving Japan for the past few months. In fact, I just saw this really interesting statistic which said that in June, the Nikkei went up by 5,000 points. And of those 5,000 points, 4,800 were from semiconductor related and AI related names. Yeah, so it's been very skewed. There's still a lot of value we are finding. We do our regular screening that I mentioned earlier. The universe is still large. So I think there's about 800 companies still that are trading below book and in Japan, and a similar number have over 30% of their market cap in cash, but it is at that lower end of the market cap.
Really interesting. You mentioned the yen. I have actually got a question about that in a minute, but somebody else has also mentioned, again, index at an all-time high. But because you have a differentiated approach, if there were a general sell-off in the topics, would the fund outperform? I mean, we would imagine it would because it's very differentiated.
Yeah, so we really, what's interesting, I think, about this strategy, it really is an sort of idiosyncratic return profile. The environment it doesn't do well in, or it tends to find more challenging, is actually the environment that we've had over the past 3 years. So the fact that we'd actually managed to post some like decent returns, even though the yen has been so against us, is I think quite noteworthy. So if you look at the profile, and you can see that in the down years, apart from the past 12 months, in the down years, the strategy has underperformed by low single digits. Whereas in Japan, you find that things move around with factors so much that when things underperform, if you're a value fund and value is not in vogue, the drawdown is really significant, and vice versa if you're like quality growth. But what's so interesting about this strategy is the downside seems to be relatively limited because all the companies are already cheap, right? We're buying companies at 5 times EV EBITDA or 8 times EV EBITDA, and they have that asset backing. But when the alpha comes through and when the returns come through, it's not just, oh, it's gone up because it's beat its forecast by 10%. It's going up because it's got rid of a non-performing part of the business, because maybe there's a takeover, something like that. So it's something really meaningful. So the upside is really significant when it does come through.
Yeah. So we talked about the yen. You mentioned the yen again. Abby in Brighton has asked, as the fund is quoted in pounds and the assets are quoted in Japanese yen, do you hedge the currency? If so, do you think that might change in the future? And she notes there have been talks between the US and Japan about intervention this week.
Yes, so we don't hedge, and the reason we don't is quite practical actually. It's just because most of our investors hedge their entire portfolio altogether, and so it's something that we're not really asked to do very often. Now, interestingly, that will have worked against our investors over the past few years. But should the yen start to strengthen, if the lady is right and we do get an intervention, then that would be beneficial for the strategy. Not so much because of a direct impact on the underlying companies. It's really more relative. So we will drag when the yen is weak, not because our underlying companies are suffering, but because those large cap exporters are the ones which are driving the index, and therefore relatively it will lag. So if it goes the other way around and you get a big reversal, as the question asked, what will probably happen is that those companies which have done very well, which have got a lot of sort of faster foreign money in them, which has been lifting up the share prices and are very liquid and easy to get out of, you'll probably see a retreat in those sorts of names first, and therefore, again, just relatively speaking, you'll see the performance probably reverse. But what we would like to make very clear is that it's not really because of the underlying companies. It's just really that relative perspective.
And I think we've got time for a final one. I've got Bob in Stratford who liked the case study and has asked, what's the best investment the trust has made since launch? And is there one and what's the holding where you see the most upside?
Ooh,
if that's not giving it all away.
I actually don't know off the top of my head, but I will say that probably it will have been one of the companies where we've had a takeover, because there are still pretty significant premiums being made. A couple of years ago, we had a company called Alps Logistics, and I think the premium was 190% or something. So it may be one of those. And in terms of what company we think, well, we see the most upside, you can see what our largest position is, and that's a company called Mitsubishi Logistics. Funnily enough, the one where we had that very large return was also a logistics company, and as I said, it's an area that we're really we're finding a lot of opportunities in. So the reason for that mainly is because a lot of these logistics companies have quite significant real estate. And even 5 years ago, we would have not really counted real estate as too much of an exciting, exciting asset to have, because most companies didn't do anything with them. But now they're under so much pressure from the Tokyo Stock Exchange, they're starting to take action. And Mitsubishi Logistics, being one of the oldest logistics companies in Japan, has had the absolute pick of the bunch in terms of prime locations around Tokyo Bay, Yokohama, Osaka, and what they have, we think, is about 200% of their market cap sitting in underutilized real estate. And so the other reason we're so positive about this is because their CEO is really keen for our advice. From day one, he's been really keen, and he's already taken steps to try and do more with their real estate portfolio, like bring in a new director from a real estate company, set up internally a group to see what they can do. So that's the one I think we're most excited about and have really high conviction in.
Do you know, that's brilliant, Nicola. Thank you. For my sins, I actually remember Alps from back in the day.
Oh, good.
Yeah. So it just rang a bell immediately when you mentioned it. That was absolutely great. Thank you very much indeed. And
thank you, and thank you for all the questions to everyone who submitted them.
Yes, I mean, if I'm afraid we didn't get through all of them, what we will do is we'll send them to you, and then we'll reply to the people that, if that's okay.
Yes, of course.
We'll get you on another webinar.